Before we move to the actual charts, I need to spend a few minutes with a very important concept which all professional traders are using. And this has benefited me also a lot, which is called as the reward to risk ratio. So we have to understand that when we are trading, there is always a risk involved. So we need to be able to control and manage that risk. So for that, we need this reward to risk ratio, which is the open secret of professional traders. When I say open secret, it's because everybody knows what this concept is, but not many are able to implement it correctly. So let's try to understand what this is and why this is important before even getting into the candlestick patterns. So I have deliberately chosen to discuss this before we get into candlestick patterns because this is critically important. Okay. So Warren Buffett, chairman of Berkshire Hathaway, the second richest man in the world, he says that rule number 1, don't lose money. And rule number 2 is don't forget rule number 1. So we need to keep this in mind that when we are coming to trade, we must not lose money. And even if we lose money, our gains should be higher than our losses. So that on an average basis, we are making money, not losing money. So let's say there is a stock which I want to buy. So this is my entry point and I keep my stop loss below that and I keep my profit target here. Okay, so this distance is my reward and this distance is my risk. Stop loss is nothing but a price at which I will get out of the market because the position is going against me. So if you are a beginner trader, if you don't know stop loss, it's as simple as that. Stop loss is the price at which you decide to exit from the market. You don't want to be in that position. You want to cut your losses short. If you don't keep the stop loss, the price may keep going down. Okay. So you want to cut your losses short. So entry, stop loss and profit target. So that's the ratio we are talking about. The reward divided by the risk. Similarly, for a short position, it will be reverse. You have the entry and stop loss, that's the risk, and you have the profit target, which is your reward, the distance between entry and profit target. So again, in this case, the same concept applies, the reward to risk. Now the question is, how much should be our reward to risk? Now I recommend for every 1 unit of risk you take, your reward should be at least 2.5. My coach, Steve Nissen, says that it should at least be 2:1 minimum. Okay. Now I have chosen 2.5 for me minimum. There is a reason we will discuss regarding this, but even if it is 2:1, that is still fine. I am okay with that. Sometimes I have taken trades which are 2:1 as well, but I prefer 2.5:1 minimum. The higher the better. Okay. So that's the basic idea. The reward to risk should be minimum 2.5. Now we can implement this in several ways. So for example, let's say the risk is 1000 units, whatever. Let's say the risk is 1000. So the reward is going to be 2500. Similarly, if this risk is 1000, the reward is going to be 2500. Just the ratio should be 2.5:1. Another way to look at this is I take 0.5% of risk. This is 0.5% of my account size. Okay. So whatever be my account size, I risk only 0.5% of that on a particular trade. So if my stop loss gets hit, I will lose 0.5% of my account. That's the idea. So if my risk is 0.5, my reward is going to be 1.25% of my account size. Okay. Let's try to understand why 2.5:1 is required. And don't worry about this percentage. I will show you how to implement this strategy while trading actually. That is when we will discuss position sizing. But please understand that the risk should be kept constant, like 0.5%. The prices and the stocks and the assets can change, but if you decide to risk only 0.5% of your account on a particular trade, then you are good to go. Okay? because you know what is your risk. You have predefined your risk. Now let's look at an example. Say there are 10 trades, okay? You have taken 10 trades. And for every trade you are keeping the reward to risk of 2.5:1. So if you lose 10, let's say, and if you gain 25. So let's say 3 out of 10 you get it right and the remaining 7 you get them wrong. So for every trade that you get right, you are making 25 units profit. And for every trade you are getting wrong, you are making 10 units loss. Okay, so total 75, 25, 25, 25. So that's total 75. Minus, this is the money that you've lost. 1, 2, 3, 4, 5, 6, 7. So 70. So plus 5, you're still making money. Okay. So now you've got 3 trades right out of 10. Only 3 trades, only 3 times you've been right. Still you are making money. Okay. So which means that the reward to risk concept is so powerful. Mathematically, you can see here, if you keep your risk constant, okay, and you keep your reward to risk at least 2.5:1, then you just have to be right 3 times out of 10. You don't have to be right every time, okay? So what happens is, this protects me from losses. This keeps my account in check. So basically what you're saying here is, when we are making losses, our losses are tiny. When we are making gains, our gains are big. So one big gain compensates for 3 or 4 losses. Okay. So that is the reason why reward to risk concept is very powerful. But keep in mind, your risk should be constant on all the trades. If you are risking 10 here and if you are risking 100 here, then the whole equation goes for a toss. Remember that your risk should be constant and your reward to risk should be 2.5:1 minimum. Even if it is 2.2:1, that is still fine. I accept that. Okay. Now let's reverse this situation. Now you keep reward to risk as 1:2.5 rather than 2.5:1. So which means if I'm making a profit, I make 10. If I'm making a loss, I lose 25. So my loss here is 25, 25, 25, that's 75. And my gain is 10 into 7, which is 70. So I lose money. So now my success rate is 70%, but I still lose money. So initially my success rate was 3:10 and I'm making money. Now my success rate is 7:10, which is very good, but I'm losing money. Okay. So my success rate has increased, but I'm losing money. Problem is the reward to risk. On this scenario, my risk is higher than my reward. My risk is higher than my reward. Okay. That is the problem. That is the problem that most traders are facing. So I can choose to keep my success rate down and make money rather than keeping my success rate high and lose money. So here the success rate is 70 and I'm losing money. In this case, the previous example, the success rate is 30 only and I'm making money. So this is the magic of reward to risk ratio. So just keep in mind, this was just a simple mathematics to show you the power of reward to risk. So 2 conditions, the reward to risk must be at least 2:1. If it is 2.5:1, even better. I prefer to have it 2.5:1. And secondly, the risk that you are taking on every trade must be constant. So it should not happen that you are taking more risk on one trade and less risk on another trade. The equation will go for a toss. Okay. So if you keep those 2 conditions in mind, you can have a lesser success rate and still end up making money. But remember the open secret of professional traders. The reward to risk ratio should be high, as high as possible. Okay. And Japanese candlesticks are a great tool to help us identify trades which give us a higher reward to risk ratio, which we will learn in the coming sections when we look at patterns. But this concept is critically important. That is why I have spent more time on this. Okay. Now let us have a look at the risk management. Reward to risk and risk management kind of go hand in hand with each other. All professional traders manage their risk diligently. Now, look at the same diagram which I had drawn previously. Let's say I am taking a long position. So this is my entry point. That's my stop loss. And that's my profit target. So let's say I am taking a risk of 1,000 rupees or 1,000, whatever currency you are using. So if my risk is 1,000 units, my reward has to be minimum 2.5 is to 2,500. Or 2,000 should also be fine. I mentioned before that 2:1 minimum reward to risk is required. If it is 2.5:1, that allows you to have a success rate of 30% only and still make money. Okay? So that is what this diagram represents. So your risk is 1,000 and your reward is 2,500. Same is the case in reverse. I keep a thought this distance is 1,000 and this distance is 2,500. Same thing, we can manage our risk by risking a percentage of our account size. Now the difference between this concept and this concept is, I like this one much better because this is a fixed value. For example, if I am risking 1,000 and if my account size itself is 1,000,000, okay, then this is very low risk. Even if I make money, as a percentage of my account, I am not making much money. Okay, so this is the correct method. I have taken training from Andrew Mitchum and Steve Nissen, and I realized that most professional traders use this method rather than this. This is an absolute number. It doesn't give any emphasis on the account size. So for example, if my account size is 10,000 and I am risking 1,000, I am risking 10% of my account, which is too much risk. Okay. So that is why I don't follow this system. Although the reward to risk and everything is satisfied here, I do not follow that system. I use a simple system where my risk is 0.5% of my account. And if I earn money, my reward is 2.5 times 0.5. Okay. So that's my reward and that's my risk. So that is the concept that I am using because it keeps my account in check. I am not risking too much. There are some people who might choose to change this amount. Like some of them are very conservative. They might take 0.25%. Some may take 1%. Some may take 2% risk per trade. But whatever it is that you choose, ensure that whatever risk you are choosing, just ensure that the percentage remains constant across all trades. Okay. So in my view, 0.25 or 0.10% becomes very less. And 1%, 2% is too large for me. I don't want to risk 1% of my account on a single trade. So 0.5% is kind of the middle ground, which I have narrowed down to. So any trade that I take, I am risking only 0.5% of my money. So if I lose on that trade, I know that I am not losing more than 0.5% of my account. So that gives me some relief. Before even I take the trade, I have already defined my risk. Okay, that is what is risk management all about. So I would suggest you use this system. You take a percentage of your account size as a predefined risk measurement tool, and then you take the trade based on the risk that you have chosen to take per trade. Now, how do you implement this? That is where we come to what is called as position sizing, which we will look at in the next video. Just ensure that for risk management is all about risking a fixed percentage of your account on any given trade and keeping that risk constant across all your trades while you keep your reward to risk high, at least 2:1. Okay? That's what risk management is all about. We have been discussing reward to risk and risk management. So let's tie that together and let's look at what is position sizing. This is very simple. All professional traders calculate their position size before they take the trade. Now this word before here is very important. You need to know exactly how much of a position you should take. You can take a major position, you can take a minor position, but you should be absolutely clear what should be your position size. So let's quickly look at some small examples here. This is very easy to understand. Do not make this complicated. So this is my entry, this is my stop loss, that is my profit target. So let's say this is a stock ABC, okay, and the current price is 310. And I want to keep the stop loss at 300. And when the price comes to 335, I want to exit. I want to book my profits. So my reward is 25, which is 335 minus 310. And my stop loss is 10. So now I have decided to risk 1,000 rupees on this stock. Say for example, let's say I want to risk 1,000 units. I'm saying units because the currency and the market that you're operating in can be very different from where I am. But let's say 1,000 units I want to risk on this stock, and my risk per share. Now this is per share risk, okay? 10. So if I have to lose 1,000 on this risk of 10, how many shares should I buy? So let's say I buy 100 shares and the price goes down. Okay, if the price goes down, I am losing 10 per share, which is equal to 1,000. So that is why I need to buy 100 shares of this account. So in that way, I am risking 1,000 units from my account. Okay? So 1,000 rupees or 1,000 units or 1,000 whatever currency you are using. So if I have 100 shares and let's say instead of losing money, I make money. So I'm making 25 per share. So 25 times 100 is 2,500, which is our reward to risk ratio. This is reward to risk ratio is 25:10, which is 2.5:1. So this is how I take the position where I calculate what is the per share risk, and then I look at how much money I want to risk on this term. Now this is something which I have pre-decided, okay, irrespective of this price, and we will look at that example. So I am willing to lose 1,000 on this trade. Let's look at another example. This is slightly different. Now here, it's a different stock, okay? Stocks can have different prices. So here the entry is 1050. Here it was 310. So the range in which this stock trades is very different. So I keep 1050 and I keep the stop loss at 1,000. And my profit target is 1175. So my risk per share is 50 in this case, correct? So risk per share is 50 and I want to risk 1,000 on this. My risk per share is 50. How many shares should I buy? So let's say I buy 20 shares. So on a 50 per share risk, if I buy 20 shares and the market goes down, so I'm going to lose 1,000 on that. So in this case, I will buy 20 only because the risk that I am taking in this trade and in this trade, the risk that I am taking is the same. Although if you notice the number of shares are different. You understand? Because the range in which the stock is trading is very different and the per share risk is also different. Here it is 10, here it is 50. So please understand that the stock price doesn't matter. What matters is the per share risk and how many shares I am buying. Because I want to keep this constant because this is our risk. And I have mentioned time and again that keep your risk constant across all trades and keep your reward to risk minimum 2:1 across all trades. So what happens is I don't care it is which stock, whether it is ABC or XYZ, I don't care. All I care is how much risk am I taking on that trade and how much is my reward to risk. In this case, the reward to risk is 2.5:1. Okay, so I am making the same amount of money here as I am making here. So to make this money on this stock, I just need 20 shares. I don't need 100 shares. To make this money on this stock, I need 100 shares because the risk per share here is low. So please understand, this is called as position sizing. The size of this position is different from the size of this position. Okay, but the risk is constant throughout the two trades. So that is how we combine risk management, reward to risk, and position sizing. Now, if I were to risk, let's say, 0.5% of my account. So 0.5% of, say, 100,000 is, let's say, 500. So if I want to risk 500 on this, so this amount is calculated because this amount is 0.5% of 100,000, whatever currency or account size you are using. So 500 is the risk that I want to take on this stock where the risk is 50. Okay, per share. So I'm not going to buy 20 shares. I'm just going to buy 10 shares because if all the 10 shares go down if the share price goes down, I have 10 shares, I lose 50 per share, I'm going to lose 500. So if the trade hits my stop loss, I'm losing only 0.5% of my account. Okay? I'm not losing a big chunk of my account. So this was an example where we looked at absolute value. So this value is fixed. This value is fixed. But we can come to this value by taking 0.5% of our account size or 1% of our account size, whatever is comfortable to you. There is no hard and fast rule. I just want to tell you that I am taking 0.5% of my account size risk per trade. Okay?